Hey everyone, and welcome to another ATLAS Annuity Strategy video. I am your host, Marty Becker, founder and president of ATLAS Financial Strategies in St. Louis, Missouri. Today I want to talk to you about why your advisor cannot beat an income annuity. And I can assure you it's not because I'm smarter than anyone else or that your advisor isn't as smart as some other advisor. It really all revolves around payout rates or withdrawal rates. You see, there are a lot of people still under the impression that they are going to get a steady 7 or 8% return in quote, the market. And they'll just be able to live off the interest for the rest of their lives and never have to touch the principal. Unfortunately, it doesn't work that way, and it never has. So this is the biggest mental shift that people who are retiring must make. You're no longer in the accumulation phase. You're in the distribution phase. It's no different than the mountain climbing analogy. While you're working, you're climbing up the mountain and saving for retirement. Now you're at the peak. Now we got to get you back down the mountain safely. So the reality of retirement planning for those of us who do not have defined benefit pensions is whatever the amount of money you have on the day you walk away from your job or your business, there's a set percentage that you can safely take every year to sustain the ups and downs of the market to hopefully have that money last you 30 or 40 years. Now, in the early 90s, that number was determined by the Monte Carlo simulations, which was 4%. Meaning for every $100,000 you had saved for retirement, you could take $4,000 and still have to pay the taxes on it. Since we live in a very different world than we did in the early 90s, and now we have super volatile markets, and we're in a low interest rate environment, according to economists, that safe withdrawal number has dropped to 3%. So just think about that for a second. For every $100,000 a person has saved for retirement, they can only take $3,000 before taxes and still have no guarantees that the money will last for the rest of their life. So what's really the solution here? You have to maximize the payout rate. And this is the area where no matter what your advisor does, he cannot increase the payout rate of your retirement funds without increasing the chance of you running out of money. So the solution is to transfer that risk to an annuity company and get a much higher payout rate. And before I get into this case study, one of the biggest reasons, or let's just call it what it is it's an excuse or a misunderstanding. But what I hear from clients is, I don't want to lock up my money. Well, if your retirement funds are there to provide you income, it's already locked up. You don't have the luxury of liquidity at that point. So you have to release the hostages in your retirement account so they can go to work for you and provide you with the most amount of income per dollar. So here's an example. If you have $1 million and you need $40,000 per year in your retirement, you are maxed out on your withdrawal rate. You can't just take $300,000 and go buy a condo at the lake. You cannot take $100,000 and give it to your kids for a down payment on a house. And if you do, you're going to have to readjust your income to a lower standard or take more risk. Now, of course, you have the freedom to move it to one fund to another. That's not what I'm saying. But the rules stay the same as far as your withdrawal rate. That never changes. So let's take a look at a case study here. We have a 65-year-old female needs an additional $27,000 on top of her Social Security. So how much are we going to have to allocate to make that happen? So if we use the safe withdrawal rate of 3%, she would have to allocate $900,000. Now, luckily, that's about what she has. If we go with the higher risk withdrawal rate of 4%, we would only have to allocate $675,000. Or we could go with the highest paying fixed indexed annuity with an income rider, and we would only have to allocate $412,500 because it has a 6.55% payout rate. Now, there's a lot of ways to analyze these things. Well, let's just focus on that bucket of money with $412,500 inside of it and see how long it would last with a traditional plan of leaving the money in the market or a diversified portfolio. So if we were to separate the $412,000 and withdraw the exact same amount of money from a diversified portfolio or the straight S&P 500, how long would that last? In this scenario, she would burn through the money by age 92 with a diversified portfolio. It's pretty good. And age 80 with all the money in the S&P 500. But we all know that's not how the world works, because the money is all lumped together working as a whole, even though it may be spread around in different funds, which is what the 60-40 portfolio represents. So how did that turn out with all the money working together? If she has the entire $900,000 in either one of these accounts, she will still have plenty of money to last her to age 100. She would still have over $2.5 million with a diversified portfolio and just over $2 million with the S&P 500. But remember, this whole time, she doesn't have a whole lot of options on what to do with all the money, because she needs it there to make the returns to provide her with the income. So in essence, the money is, quote, locked up. So let's see what we can do with an ATLAS Annuity Strategy and how that would compare if she allocated the $412,500 to an annuity and left the remaining $487,500 in either one of these portfolio options. Now in this scenario, she would have over $2.8 million in the diversified portfolio and almost $3 million in the S&P 500. And by the way, I did not count any of the account value of the annuity in any of these equations. I just took it straight off the table. Now, one more scenario that I know a lot of people are thinking about, because it's on everyone's mind, and that's inflation. So we do have to keep this in perspective because we are living in an anomaly of time with this current inflation rate. But inflation has been right around 2% for the last 20 years or so. But we can take a look at that too. So if she were to increase the $27,000 income every year by 2.5%, what would the traditional plan look like? Well, that brings her remaining balance at age 100 down to $1.58 million in the diversified portfolio and just under $900,000 with the S&P. Now still, that's a pretty big difference, but she didn't run out of money, but the inflation made a pretty big impact on it. And how does that scenario fare against the ATLAS Annuity Strategy? By using the annuity for the guaranteed income and taking her inflation increases from her portfolio, she ended up with $1.86 million in the 60-40 portfolio and $1.82 million in the S&P 500. So what's the whole point of this? Really, the point is, I don't want you to fool yourself that just because you have a big pile of money, that you can actually use that money for what you want, if its purpose is there to provide income for the rest of your life. Again, this is the difference between accumulation versus distribution. You cannot just go out and spend whatever you want with your retirement money unless you're willing to adjust your annual income or you're willing to take more risk, which can backfire on you big time. So, in which one of these strategies is your money really locked up? The traditional plan, where your money cannot provide the things that you want for retirement, which at the end of the day is really just options for your lifestyle, or the ATLAS Annuity Strategy that guarantees your income needs with a portion of your money and then leaves the rest for you to do the things that you actually want to do the things that you've been working for your entire life while you've been saving this money for retirement. These numbers don't lie. I copied them right off the S&P 500 and the past 20 years of a 60-40 portfolio. Anyway, I really do hope that this helps. I don't make these videos to berate people on their decisions that they've made up to this point, but to really just to educate people that there are other options available. So I encourage you to reach out and ask me questions on why and how this works. And the best way to get a hold of me is by reserving a time for a short phone call by going to atlasannuity.com. Or you can shoot me an email at marty@atlasfinancialinc.com. You can try calling me. Normally I don't have time to answer, but if you leave a message, I will do my absolute best to get back to you. Anyway, I hope this video finds you well, and I wish you all the best in this new year.